Okay, good afternoon or good morning, or perhaps in some cases, good evening. Welcome to our webinar. Now, while the validity of climate change still seems to be being debated in some perhaps dark corners of the world, no one can escape the fact that the climate issue has triggered a technological revolution, which poses a significant threat to companies, or in this case, investors that rely on the outgoing technology to form a substantial part of their earnings or returns. And so in our webinar today, we're going to dig underneath the bonnet and discuss the effect of the transition from ICE cars to EVs and what effect that will have on the auto asset-backed securities market, a market that is growing at speed and is second in size only behind the mortgage ABS market. My name is Simon Perham. I'm part of the investor outreach team here at Carbon Tracker. Prior to Carbon Tracker, I spent too many years, the best part of 32 years in the city, almost entirely as an equity broker on the sell side. Today, I am joined by Ben Scott, a senior auto research analyst at Carbon Tracker and the author of the report. Ben started his career at IHS Markit, and after a spell at Aston Martin, he left. Clearly the company cars were not up to scratch, and he joined MUFG Bank as an autos analyst. Also joining us is Jonathan Haybrook, senior analyst at the Green Finance Institute. Jonathan joined the Institute in 2020, and his work spans both the transport transition as well as EU taxonomy and analytics. Prior to the GFI, he spent spells at Alliance Global, Peel Hunt, and Standard Life. So, what should you be expecting today? The objective of the webinar is to deliver you, the audience, a practical, pragmatic and balanced set of opinions on the issues facing the auto ABS market today and tomorrow. We have a target runtime of between 45 and 50 minutes with a hard stop at 60, depending on the volume of questions submitted. Ben will spend 12 minutes or so taking us through his presentation slides. Jonathan will then spend a further 5 or so minutes drawing focus onto the green auto bond markets and how they're going to manifest themselves going forward, after which we hope to be able to answer any questions you may have. And as moderator, I'm here to give you, the audience, a voice in this debate. So please submit your questions in the Q&A function below. However, when submitting your questions, please do not submit them anonymously, just in case we do not get around to answering them live, or and we need to follow up with you after the webinar. So, house in order, let's get started. I'm going to share my screen, and before we start with Ben, what I'm going to do is perhaps take you through, some of you may not know who Carbon Tracker is, and just explain a little bit about them. Carbon Tracker is an independent, not-for-profit research house that converts climate science into financial risk and, in some cases, reward. Our mission is to see an energy system that is sustainable within close proximity to a 1.5 degree warming scenario. Our research is focused on 3 core themes: oil and gas, power and utilities, and more recently the heavy emitters, in which Ben's team fits. And these core sectors are cross-cut with several sub-initiatives which add a further level of focus and detail. And lastly, where can you see all of our research? Well, our research is free to download on our website, www.carbontracker.org, or is also available on the usual third-party platforms, Bloomberg, FactSet, Thomson Reuters, who is now Refinitiv, and S&P Global Capital IQ. So that's me done. Ben, over to you.
Fantastic. Thank you, Simon, and good afternoon, everyone. Welcome to today's webinar, Auto Loan, ABS, and Asset-Backed Insecurity. So looking at the agenda today, this is what I'll be talking about. So the presentation will discuss some of the key findings and messages from a report I published last month called Blind Spot Auto Loan ABS, which looks at the risks to investors of bonds collateralized by internal combustion engine vehicles, which we are calling an asset-backed insecurity. Next slide, please. So why are we talking about the auto loan ABS market? Why is it important? So first thing to note is that the global auto loan ABS market is significant. It's very large and it's growing. It's the second largest ABS market after the mortgage-backed securities market. So that gives you an idea of scale. Global annual auto loan ABS issuance is between 150 and 200 billion US, and this is likely to rise to more than $250 billion as vehicle production volumes approach pre-pandemic levels and vehicle financing grows in places like China. So, leading up to 2021, it's indicative of the growth of the auto loan ABS market before vehicle financing took a hit because auto manufacturers couldn't build enough cars as a result of the pandemic, the semiconductor shortage, etc. And secondly, this financial market is related to a sector that is in transition. Battery electric vehicles are rapidly entering the fleet, demanded by customers rather than an industry push. And this is set to rapidly change sector dynamics, and in turn, this will impact investors, OEMs, and many parts of the value chain. Next slide, please. So this is a chart from Bloomberg New Energy Finance, and this shows investment into global new energy split by energy supply. So these are things like wind and solar and battery storage, and also energy demand, where the technology is mainly energy consuming. So this is predominantly electric vehicles, but also heat pumps as well. And in 2022, this is the first time that demand side investment has been greater than the supply investment. And this suggests a shift from a supply push transition to a consumer demand-led transition. And now why is this significant? It's significant because demand-led transitions are way more profitable than a supply push, and profits shift capital quickly. And this non-linear investment suggests the shift to electric vehicles will not be linear and will accelerate, which is supported in the next slide. So I wanted to share a piece of analysis we did with our partners at New Automotive, looking at the uptake of electric vehicles in the UK. So here we are showing market share of electric vehicles and internal combustion engine vehicles in the UK using actual data. And we chose the UK because it's not the most advanced in terms of electric vehicle adoption, but it's also not the furthest behind. So it's a good middle ground. And through our modeling, we believe that EVs are following an adoption S-curve, which is quite typical for any kind of technology transition. And what this shows is that the transition will be non-linear and faster than many people expect. And this effect will be mirrored globally, but every country is at different stages along that S-curve as we move from an industry push to a consumer pull for EVs. Next slide, please. So the question on the slide here is, who wants to buy a traditional internal combustion engine car when you can acquire a better electric version? And we believe that there are 4 key factors which will limit internal combustion engine vehicle ownership. So the first is the total cost of ownership. The total cost of ownership of an internal combustion engine vehicle is higher than that of an EV. We also have legislation which will ban or phase out the sale of internal combustion engine vehicles by the 2030s. We have low and zero emission zones as well. And this will reduce the utility of internal combustion engine vehicles. And then lastly, internal combustion engine vehicles will be seen as outmoded technology. The battery electric vehicle is an overall better consumer product, offering benefits such as faster acceleration, a quieter drive, home refueling, etc. And in addition, OEMs will bring more innovation and software to electric vehicles. As battery electric vehicles are rated to last more than 200,000 miles with limited battery degradation, as the powertrain becomes commoditized, new software and services will be offered to the consumer, bringing higher margins to automakers compared with the traditional business model of building and selling cars. So think of an EV as a smartphone. So why does all this matter? It matters because these factors will have a detrimental effect on the residual value of internal combustion engine cars. Residual value is critically important because in most vehicle financing or leasing, the vehicle is sold at the end of the lease, which is also when the auto loan bond comes to maturity. There is usually no recourse from the OEMs, so all that risk sits with the bond investor. And if that residual value is not what you expect it to be when the bond matures, bond investors could face lower or negative returns. Next slide, please. Vehicle financing is very important to the OEMs, and here I've called it the jewel in the crown, as it provides several benefits, and the 2 main benefits being profitability, so that the captive finance arms of OEMs are often more profitable, the most profitable part of their business. And secondly, it offers improved liquidity. Through the securitization mechanism, where auto loans are pooled together and sold as bonds, it enables the automakers to move illiquid auto loan assets from the balance sheet, therefore improving their capital structure. One click, please. Since the early 2000s, the percentage of consumers using vehicle financing or loans has grown and improved consumer accessibility to new vehicles, pushing annual global new car sales to more than 90 million vehicles. And this was pre-COVID. And in the largest markets in Europe, more than 80% of new car sales are purchased using finance. And again, it's around 80% in the US as well. And in China, the single largest car market, vehicle financing is only around 40% at the moment, but the Chinese vehicle finance market is still relatively new and is expected to grow in the coming years. And of course, financing is being used to buy electric vehicles, helping to bring cars to market. And we saw that with the S-curve adoption chart earlier. And what that does is kickstart this feedback loop, which will have a detrimental effect on internal combustion engine vehicle residual value. Next slide, please. So the feedback loop I'm referring to, which will have a negative effect on internal combustion engine vehicle residual value, is what we are calling the wheel of misfortune. So if we start at number 1, just one click, please. So we have global automotive OEMs. They're bringing more battery electric vehicles to market across the vehicle segments. Moving on to number 2. We have more battery electric vehicles coming to market, which will legitimize the market, enhancing battery electric vehicle residual value. And at the same time, the limiting factors to internal combustion engine vehicle vehicle ownership will become increasingly apparent, reducing residual value. Moving on to number 3, the fall in value of internal combustion engine vehicle collateral will put the associated auto loan bonds at risk of lower or negative returns for the investor. Moving to number 4, due to the strengthening residual values of battery electric vehicles, investor focus will shift towards bonds only collateralized against battery electric vehicles. As this residual value risk gets priced into ICE vehicle auto loan bonds, investors will demand a higher return or interest rate. It's classic risk and return. And this will squeeze the net interest margin that automakers earn on internal combustion engine vehicle auto loan securitization. And then moving to number 5, for the automotive manufacturers, comparatively, this will make selling internal combustion engine vehicles less profitable and battery electric vehicles more profitable. So automakers will be forced to accelerate the production and sale of battery electric vehicles, and the cycle continues, and it will accelerate. Every revolution of this wheel gets faster and faster. And it actually may turn out that automakers in the future actually find it very difficult to securitize and offload from the balance sheet these auto loans where the collateral is internal combustion engine vehicles. And this would mean that these loans now sit on the OEM balance sheet, skewing its capital structure and potentially impacting cash flow timings as well. Next slide, please. So in the report, I suggest 4 possible scenarios for internal combustion engine vehicle residual value, from business as usual, where an ICE vehicle depreciates quickly in the first year, with the depreciation rate leveling off over the useful life of the vehicle. And this is quite typical for car depreciation in normal circumstances. However, the automotive energy transition is a radical shift in powertrain technology and a once in a 100+ year event. So it's very unlikely ICE residual values will follow this business as usual scenario. So it is far more likely that internal combustion engine vehicle residual value will follow one of the scenarios 2, 3, or 4, or a combination of these 3 scenarios. And I'm not going to talk in detail about each of these scenarios, but you can find them in the report. But the key point here is volatility. As we approach the 2030s, due to the automotive energy transition, ICE residual value is going to become more volatile and difficult to predict. And the unpredictable nature of ICE residual value is the enemy of bond investors. And these auto loan bonds could yield lower or negative returns. Next slide, please. My final slides. So if we move it 1 click on. So number 1, just to summarize, auto loan ABS market is globally significant, and is the 2nd largest ABS market after the mortgage-backed securities market, and could grow in the near term to $250 billion annually. Point number 2, global EV adoption is likely going to be non-linear and will accelerate, and is on an adoption S-curve. Number 3, please. There are inherent risks associated with ICE vehicle residual value, and we've seen how the wheel of misfortune will accelerate. And number 4, there will be increasing volatility of ICE vehicle residual values, and increasing volatility is the enemy of bond investors. And number 5, and finally, these ICE vehicle risks can be mitigated through green auto loan bonds. And I'm going to hand over now to Jonathan, who is going to talk more about this and give his overall remarks on the report. Over to Jonathan.
Sure, thanks for setting the stage, and thanks for having me. You touched on some of the critical points, which I'll try and build on. And I specifically want to talk about the impact of the changes, what I see is positive changes that the transition is having on auto debt issuance by really flipping the switch from a scrutiny on electric vehicle asset risk to scrutiny on petrol and diesel asset risk. But if we take a step back for a second, we all know that finance is a critical enabler of transformative improvements to decarbonise the road transport sector, and the debt markets have an important role to play in financing that transition, where companies are looking to finance their efforts to reduce their carbon emissions, to adapt to climate change. It will often raise capital to support that transition, and as a result, you've seen global sustainable debt issuance grow year on year, led predominantly by the increase in green bond issuance, especially. Auto ABS debt instruments has been touched on, are obviously securitized pools, buckets of those auto loans collateralized by vehicles, by cars, by trucks, and these securities derive their value from the payments made by car owners on their auto loans and leases. And these, as Ben touched on, these payments are then pooled and sold as securities to investors who receive the principal and interest. Green securitization, like green auto ABS, can help lenders mitigate their residual value risk exposure, and that can help them free up balance sheet, which can be redeployed to originate more EV loans. So it's a very useful instrument, and there are benefits beyond risk reduction in terms of green ABS offering the chance for better returns relative to other comparable fixed income products, lower loss rates, funding diversification, and also creates an investable product for investors. So what this report quite rightly points out is when looking at these securities, it's important to consider the residual value volatility for internal combustion engines and its possible impacts on the return profile for auto ABS. So if RVs for ICE vehicles become more volatile due to fluctuations in fuel prices, more stringent regulations, changing of emission standards, not to mention the wider transition to EV, we can expect potential implications for auto ABS. And the domino theory here is that if the resale value of ICE vehicles drops significantly, it could cause losses when the leases end, which diminishes the cash flows for the securities and shrinks the return for the ABS investor. And a steep drop could make leaseholders default or stop making their lease payments, particularly if there are walkaway clauses in place, leading to even less cash flow going to the ABS. If that does happen, rating agencies could then potentially add haircuts to predicted residual values for ICE assets in order for those deals to achieve a desired credit rating, indicating a perception of higher risk due to the transition to EV. And then with this perceived risk, it might make investors demand a higher return for taking on that risk. And they might call for extra safeguards in the form of credit enhancements, which again could increase the cost of ABS issuance. And so ultimately, all of this elevates the cost of capital for new ABS issuance backed by these types of assets, and it will reshape the financing landscape for the auto industry as we know it, from a focus on the risk associated with electric vehicles to a focus on risks associated with petrol and diesel vehicles. So you're gradually going to see this reversal, this inflection point, where the investor might actually prefer a higher proportion of electric vehicles in their ABS pool, which would have been unthinkable a few years ago. Everyone's talking about what percentage of EV is in this pool and concerns around it. So what is the bottom line here? For me, it's that investors should brace for the impacts of the transition. Their focus up until now has been on that risk associated with electric vehicles, but it's really, in my opinion, time to flip the coin and start worrying about their gas guzzling assets as well. They need to understand and to manage that transition risk, stranded asset risk, and really digest the pace of change and ultimately position themselves to capture alpha by limiting their exposure to upcoming risks. And then on the positive side of things, then the inverse will be true of EV assets. So where their diminishing risk will hopefully be priced in, perhaps a green premium will emerge, it'll become more attractive for maybe even non-ABS investors because it's that green asset that they're craving. And so you could see a green emerge, and that could be passed on, that benefit could be passed on to the consumer in terms of lower monthly payments, which would, of course, further accelerate adoption. So ultimately, we're in the midst of a major shift, a change that's not just about cars and roads, but also about how we invest and where we see value. And it's really about time that we start looking at both sides of the coin and reconsider risk assessments, methodologies, and forecast models to embrace the transition for what it is. But anyway, I'll park it there and
Great. Thanks, Jonathan. And before you settle down and put your feet up and grab a cup of tea, I've got a question coming in from Steve, which I think is a good place to start. What is, and it's probably the elephant in the room in many cases, what is the EU taxonomy around green auto, loan bonds, and how is green defined?
Yeah, it's a really good question. I think the first thing I'd say is that the definition for green and sustainable bonds has been up for debate for quite some time now, since the EIB issued their first green bond. I think it was back in 2007. I could be wrong there. You are increasingly seeing tools becoming available in the market to set such definitions, and that allows for standardization and comparability. Chief amongst those tools is probably the EU taxonomy, which is a classification system, essentially a dictionary, which sets out the economic activities which can be considered environmentally sustainable, and it sets thresholds for what can be defined as green. And we're also creating our own taxonomy in the UK, which I'm glad to be a part of, and you'll see numerous other countries developing them as well. And then linked crucially to the EU taxonomy, you have the green bond, the EU green bond standard, the EU GBS, which takes the taxonomy definitions and it sets a gold standard for using and labeling green bonds to ultimately finance green activities. And the EU taxonomy, it focuses on tailpipe emissions, it focuses on that 50-gram threshold till 2025 and 0 grams from 26. But increasingly, you are seeing a focus on life cycle emissions, and that's what investors also concerned, worried, and want that data available to them. When it actually comes to green auto ABS specifically, the debate has been on whether it should be green assets or green use of proceeds. And we've actually seen from the leaks EU GBS, the draft text, that green securitization will be included and it will be defined by proceeds rather than assets. So I should just mention that that's yet to be confirmed. I think the text is due out in September time, but it does seem, at least for the time being, that definition is set. But what I would also say is that investors should look into rules around grandfathering as well. So is it green at the point of issuance? What happens if the threshold changes? Is it indefinitely green? Is there a certain time horizon? Is it 5 years, 7 years? What can they count on for how long that asset stays as green? But yes, hopefully we are moving to the point where we've got a solid definition.
Great, thanks for that. And we've got a couple of follow-up questions, but I think I'll perhaps give you a moment to pause. And I've got a question here for Ben, and it's from our good friend Malcolm, who is a regular sort of attendee of these webinars. And thank you, Malcolm, for your support. We massively appreciate it. I think I know the answer to this, but he asks, he's got two questions, but I'll go with the first one. How does your model properly take into account the continuing need for normal ICE in a wide range of automotives? And he quotes here agricultural, heavy goods vehicles, etc. Yeah, Ben, what would you say to Malcolm on that?
So in this particular report, we mainly focused on the passenger vehicle segment, and the passenger vehicle segment is shifting most quickly to electrification. So that's why we focused on that market. But in terms of sort of other neighboring sectors like heavy goods vehicles, agriculture, aviation, etc., there might be a case for alternative fuels. Sustainable fuels potentially could be in the mix alongside hydrogen. However, having said that, I think the majority of the technology will be battery electric in most of these instances. So yeah, I think there is opportunity for potentially for other fuels in neighbouring sectors, in the difficult to abate sectors, but for the passenger vehicle segment, which is what this report focuses on, I think it's going to be entirely electric.
And a sort of similar question from Georgina, who's sitting in New York. Are e-fuels going to prolong the life of new and used ICE vehicles and therefore reduce the ICE bond risk? What do you reckon?
On e-fuels, I don't believe so. So whilst the EU recently made a concession to allow the sale of new internal combustion engine vehicles which can run on e-fuels beyond 2035, I don't think e-fuels will play a major role in the future of mobility for a few reasons. Number one, they are very expensive, so they will only be affordable for the luxury car drivers of this world. Number two, producing e-fuels is incredibly energy intensive, and I don't think there'll be enough surplus renewable energy to synthesize and produce these fuels at scale. And number three, most manufacturers now, most automakers, they are switching to an electric only strategy going forwards. They're not thinking about internal combustion at all. So e-fuels is just a distraction.
And I'm just going to go back to Malcolm's second part of the question, and perhaps I could actually answer that. He talks about the lack of infrastructure investment in for EVs, and obviously that is a problem. But he cites Texas currently restraining further investment in both wind and solar. Malcolm, a couple of interesting stats from the EIA. Last year, the US put 1 million plug-in electric vehicles on the road, and that, using standard demand models per vehicle per year, was about 3.7 new terawatt hours of demand. And in the same year, the US actually added 96 terawatt hours of renewables. So we ain't going to run out of, or they ain't going to be running out of electricity anytime soon. I want to move on to a question really following up for Jonathan here, from an anonymous attendee. Jonathan, wouldn't what you previously said mean that the EU GBS then goes against the report's primary point of having green assets as opposed to the use of proceeds?
I think it depends on the short or the long term view. So realistically, in the short term, you're not going to see 100% green assets and 100% green use of proceeds. That's sort of pure play green auto ABS. So it will be a gradual shift where you increase the proportion of electric vehicles within that pool for the security. And then maybe in a year's time, when there's more critical mass of EV assets to securitize, and you've got a 200 million bucket of assets to securitize, then you'll see pure play green and green. But for the time being, it's just a ratcheting up of the EV portion in those deals. And so what a rating agency does is it will haircut the electric vehicle portion on that pool. But increasingly, I think it could change. I still think the argument that the report makes around the residual value on the ICE assets is still relevant, because that is a consideration that the rating agencies and investors still need to make. So it's a definitional point that it will change over time, but you need to factor in those residual values as the pool changes, if that makes sense.
Okay, this one is from Kenny. Kenny is asking, and I think it's a poignant question here, with the growth in auto lease models, where does EV auto lease ABS factor in alongside electric vehicles auto loans ABS, both in terms of financial returns and ESG stroke impact considerations for investors? Who wants to take that one first? Don't all rush at once.
I'm happy to jump in. So I think it really, from a returns perspective, it's a bit of a cop out, but it's the risk tolerance of the investor. And there are obviously differences between auto lease ABS and auto loan ABS. I wouldn't have thought, my first reflection is that the ESG impacts wouldn't be different for those two, but I would need to give that some more thought.
And in terms of financial risk and returns, Ben, any thoughts on this?
No further comments really. Just to kind of reiterate what Jonathan says, it's kind of depends on what your risk profile is, essentially.
And a sort of follow-up question really from Alice. Thanks, Alice, for joining. Are the majority of investors, especially non-ESG focused investors, tuned into these risks with the auto ABS? Do we think that this is already priced in? What's the feedback that you're getting from people? Yeah, I know, Ben, you've made a couple of these presentations. How far away are we from pricing this kind of risk into the marketplace, or are we not at all?
My view is that this risk is not priced in currently to auto loan ABS, and it should be. Investors should be asking for more reward for taking that risk. If you look at the auto loan ABS market over the last couple years, they've been performing quite strongly because there hasn't been enough flow of new vehicles into the market because of the overhang from COVID. Not enough vehicles were being produced, semiconductor shortage, etc. So, looking back historically over the past 2 years, auto loan ABS has actually been quite a good investment. However, having said that, going forward, we're seeing more EVs entering the space. The automotive space is going through this massive transition right now. So I don't believe that the risk is actually being priced into the bonds right now, and it should be.
Okay, we've got a couple of questions here, one from Irena and one from another anonymous attendee. And it's all about the impact of battery technology. And so I think this probably encapsulates it best, given the technology around BEVs is non-linear and similar to uptake. And particularly in around the useful life of electric vehicles, and how much of a challenge is that going to be for the packages of these loans, and the investors to be able to price them and assess the risk they're taking?
Yeah, I think it's a good question, because there are lots of battery chemistries out there, and there seems to be news stories every week about the latest and greatest battery technology that is going to enhance the range of electric vehicles. Having said that, automakers now are telling us that the batteries that are being deployed in vehicles now are actually lasting longer than they had initially expected. So over the useful life of an EV, you may actually have longer useful lives than compared with an internal combustion engine vehicle. And this is going to help with overall residual value for electric vehicles versus internal combustion engine vehicles. They are likely to last longer than a comparable internal combustion engine car.
Yeah. Jonathan, perhaps one for you. What are the major obstacles you think that are putting on the brake of being able to expand the growth and of the green bond market? What do you see investors need to be looking out for in particular for particular specific policy announcements or changes that will say to them, okay, that this is going to be easier, this is going to be easier to deal with?
Sure, I think there are a few considerations for investors in terms of the actual barriers to the market. I think the two main ones are still the lack of green collateral, as I previously mentioned, so the lack of supply of green assets, but also the debates around green labeling, which I also mentioned earlier, so the issues around definition. And so I think we have seen over the last few years, and the reason why it's behind mortgage-backed security issuance and RMBS, CMBS, and covered bonds is that, the definition point, and it creates uncertainty in the market, and you've had a cooling period where an originator won't want to come out with a new issuance because they're concerned that they'll be accused of greenwashing. There have been some transition type deals done already, and it hasn't necessarily received a standing ovation from investors. So I think they're waiting for the time being to really be confident in what they're including in their portfolios. And I think you will see this change over time, but it is a case of a little bit of wait and see. I don't think there are the same concerns that there were with investing in securitization that there were a few years ago. Perceptions are changing, but right now probably isn't the right environment in a high interest rate environment to see new issuances come to market, and it's not the right time necessarily. But I think when the market emerges again, I think it'll become a really interesting proposition for investors.
And a question coming in from Miranda, who, blimey, she's out in Hong Kong, crikey. You're having a late night. How important is the development of used vehicle financing in the EV space? How important is the development of that market to the development of the new electric vehicles, and will that, if you have a substantial used vehicle loan market, will that reduce the volatility of the electric vehicle market, the new electric vehicle market? What are the effects? Really going back to the question, sorry Miranda, I'm making a right mess of this. How important is the development of the used vehicle financing market for the development of the new electric vehicle ABS market? Ben?
Yeah, I'll start off and maybe Jonathan can finish. I think, obviously new and used cars, they are linked, and having that flow of vehicles into the market is important, but of course you have a fleet of vehicles as well that are already in operation. So used car financing is growing. It varies by country to country, but in developed countries it's roughly around 40% of used cars are bought into finance, and we do expect this number to grow. So that that global auto loan ABS market figure that is up to $250 billion US, that we showed that earlier, that has the potential to grow even larger. So yeah, I think having that financing options for used EVs will certainly help the market and will help the flow of these vehicles.
Jonathan, anything to add to that?
Just say that obviously the two markets are incredibly interlinked, and supply and demand constraints as well are keeping used vehicle prices quite high at the moment, and you're seeing some pricing improvements, but they're still not where they were pre-pandemic levels because of plant shutdowns, chip shortages and things like that. But you are seeing some interesting trends that are emerging. You're seeing longer vehicle ownership, you're seeing fewer lease contracts, people are buying out their lease contracts in quite a few cases, and you're also seeing quite a few expensive new cars coming to market, which drives demand in the used market. And so obviously those two things are linked, and pricing will slowly drop, but the used market is still dealing with some of those issues from the pandemic.
And just a sort of follow-up question. I've got a couple more, but just a quick follow-up question from Isabella saying, are the returns, okay, so we all move to electric vehicle financing. Are investors, or should investors, expect similar returns eventually from electric vehicles to what they did to ICE vehicles when the market starts to mature, or is there going to be a difference in bonds, returns in the two bond markets? Does that make sense?
I would say it'd be similar. I mean, with EVs coming to the market, it's a direct substitution for what otherwise would have been an internal combustion engine vehicle sale. So whilst we are going through this transition period, and as Jonathan just talked about, there will be kind of different ABS with different ways that you can kind of securitize and bring these bonds to market. But I think it will more or less be the same, and the returns will be very similar to what were earned for internal combustion engine vehicles over the last sort of 20, 30 years or so.
Okay, I'd like to move on to Alice. Alice is back, and she asks, what about the role of SLBs in transition from ICE to EV? How do you see this instrument complementing green bonds in the transition of the sector?
I'm happy to jump in there. I think it's just an alternative funding source. So that would be at the entity rather than the product's level, and would tie the originator, the OEM, to certain commitments over time. We have had discussions with some originators who liked the idea of a KPI-linked securitization. Obviously, most that you're seeing at the moment are sustainability-linked bonds, as I say, at the entity level, which ties debt instruments to predefined sustainability targets. They have been accused of greenwashing as of late, and there's been a lot of criticism of sustainability-linked bonds, that they're not in alignment with SBTi's transition pathways, that they're not aligned with net zero. One thing I think could improve with SLBs, and if you were to do a securitization linked to it, would be if you had more transparent emissions profiling from one auto ABS to another. So if you have a publicly traded securitization, if you say these are the financed emissions of the pool and this is the financed emissions of the use of proceeds, essentially, that is valuable information for an investor who can demonstrate their impact. So I think if you can tie a securitization to taxonomy alignment, or to an SBTi aligned transition pathway, or an emissions profile change, step change year on year, for instance, then I think that's one way to do it. But there is hesitancy at the moment around transition products. But to a certain extent, transition is baked into the fact that it is defined as use of proceeds. So that is one option for investors at the moment.
Ben, anything to add, or shall we? I've got another question from Kenny, which is probably a good place to finish the webinar. So if I just read Kenny's question out, which, and he says, and you know, given all the positive indicators outlined in this call so far for EV ABS over ICE ABS, is this something that investors have already latched onto en masse, and that essentially we are already seeing a growing bifurcation in terms of spreads between the two? And I guess, in other words, is it already priced in? I mean, you've mentioned before, Ben, that you don't think it is. What evidence do you have that you don't think it is?
Yeah, it's a good question. I think I don't believe that it's priced in. I don't think that risk is priced into the bonds yet. And we talk about this in the report itself, and there are a few reasons why I don't feel that's priced in. One of the reasons I mentioned earlier was kind of the masking of used car prices in the last sort of couple of years, and that's because there hasn't been that flow of new vehicles entering the market, therefore making used car sales, or used car prices, I should say, more buoyant. We're seeing a wholesale ban on a powertrain technology as well. That's never happened in the automotive space. That is clearly has to have an impact on residual value and the risk associated. And then some other factors as well. Again, these are detailed in the report, so you can kind of read that at your leisure. But we also talk about the Osborne effect. We also talk about production overspill of internal combustion engine vehicles, where manufacturers aren't able to shift in an agile way, therefore producing too many internal combustion vehicles and reducing the residual value of the used car fleet. And then lastly, just to kind of finish off on, we have changing consumer sentiment towards EVs as well. At some point, it will be socially unacceptable to buy an internal combustion engine car. So EVs are the only way that you can perhaps even buy a car. And so that's also something else that will happen in the near term, and will have an impact on that residual value as well. So yeah, overall, I don't think that risk is priced into the bonds yet.
Jonathan, from what you're seeing in terms of the structure of the market, the way that the players are putting together, these bond structures, do you see any evidence that what we're talking about is already priced in the way that they're structuring these instruments, or do you think there's plenty of what's the word, inefficient market still to come?
I think probably the latter. I think there's still quite an over-reliance on the rating agencies. And we take an internal house view that the rating agencies are quite conservative in the way that they apply haircuts to electric vehicles rather than ICE or the other way around. And originators obviously take RV data from data providers or maybe apply their own internal methodology. So they apply some small haircuts themselves anyway. So the fact that additional haircuts are added on top suggests that this isn't priced in, or isn't priced in for the time being. And they're also stressing it because of resolving the revolving periods included in those issuances. So I think until the rating agencies change their methodology, and when they're absolutely sure that electric vehicle residual values will perform how we think they're going to perform, and the data is there, until they change their methodology, I don't think it'll be priced in.
Is there enough data out there? What's the quality of the data like? David's just come in with a question, and this will be the last one. Is there a good set of data that these people can use, or is it just simply not enough?
On residual values?
Yeah.
I think one thing that investors want to see is more historical data. So some of the data providers will say, yes, that data is there. And some of the investors will say, well, we want to see the vehicle go through a full cycle to be absolutely sure. I think the truth lies somewhere in between the two, that we're almost there in terms of the full cycle, the full data that investors need and require. But the data we do have suggests it's comparable to internal combustion engine. And so as long as it's predictable and you don't have that level of volatility, that's when you provide certainty to an investor. It takes away the unpredictable elements that they're concerned about. So I think the data is there. I think more can be done to aggregate data. There are antitrust issues with that potentially. But yeah, I think as soon as you have that 5 to 10 year data coming through, that's going to be a strong support, certainly.
Ben, would you agree with that?
Yeah, I think so. I mean, the EV market is still fairly nascent, and once we have more EV models on the road, which, as Jonathan's mentioned, has kind of gone through that life cycle across various different brands as well, then that will enhance the data and enhance investor engagement. Okay,
great. That's fantastic. Look, lastly, before we wrap up, just to look forward to a couple of other interesting reports we've got coming up on Carbon Tracker. We're going to look under the waterline of Enel's transition plans. That's a report coming out within the next 2 to 3 weeks. We're going to take a peek behind the scenes at the UK wind industry. Lorenzo is busy finishing off that report. That's coming out very shortly. And also an interesting report. We're going to be riffling through the small print of the economics, the science and the maths to see why financial advice to government, central banks and to pension schemes, many of who are watching today have pension and schemes, about the climate, the effects of climate change on GDP, financial systems and your own personal pensions, which according to this report is bordering on scandalous. So there's 3 or 4 reports there all to look forward to, and when we do the webinars, I hope many of you will join us. And it really just remains to thank you, Ben and Jonathan, for a great webinar, and to thank our behind the scenes team led by Evgenia, and to thank you, the audience, for spending your valuable time for us, with us. And we very much look forward to doing this again, and hope to see you joining us again. Thank you very much indeed, and have a great rest of the day.